So you've probably seen online where people have been advertising that they are real estate syndicators. They buy properties and they're looking for people to lend them money. A lot of times they're called private lenders, lending them money to be able to buy these assets. A lot of these individuals are guaranteeing a rate of return. I'm doing the same. My name is Ken Frank. I'm in the real estate business. And why and how we're able to offer a guaranteed rate of return versus stocks, I'm going to show you right now. So a lot of times when you buy a stock, I just looked at my phone. Berkshire Hathaway is at about $778,000. This is sold on the stock market. So whenever you go to purchase that at the time of your purchase, it's going to have a certain price that you're going to have to pay. Now, when it comes to an asset like homes, let's say somebody has a home of an asset of 778,000. They live somewhere in, let's say, Clarendon Hills, and they're selling this house. They're for sale by owner, and they're willing to sell the house. You may be able to purchase this house on a discount. Let's say, just because just naturally people just don't know how much everything is worth. Individuals have a different price on everything. They might see repairs that need to be done or other certain things that they have to deal with, whether it's liens or taxes, where they feel like the value isn't there for their property for whatever reason, or that the market fluctuates. So you'll be able to buy, let's say you buy this property for, let's be very conservative, let's say $730,000. So this margin here is why they're able, or any individual that is offering guaranteed rate of return is able to guarantee the rate of return. If you invest smartly, you won't invest more than, let's say, 80% of the actual asset value when you put in the money, whether it's cash or any other way you find to fund the purchase of the property. You're only 80%, so you have a 20% margin. So if you're using somebody else's money to get the 730,000, or you have other private lenders, they're able to offer you, let's just say, a 7% increased return on that investment. Versus the stock market, something like Berkshire Hathaway, that's owned by or ran by Warren Buffett, which is a risk right now because if he was to pass away, this stock market price might be at risk, and it might not, because they have a lot of things in place to run the business. And life is crazy anyway. Warren Buffett can outlive a 12-year-old or somebody out here in the world. You never know what's going to happen. But let's say you were to purchase this stock, you're going to have to purchase it at an efficient stock market value. So let's say it drops $2,000. You're not going to be able to buy it for anything besides $776,000. Now, Berkshire Hathaway A is not a typical stock. It's a lot bigger stock than a lot of the other ones I know, but it shows you an example that's similar to a house just based on price. Because a lot of people look at houses, they're $350,000, $500,000, and then stock prices typically are, let's say, like $200 to $600. But they are both assets and they're both investments. So it's good to look at other type of investments you could put your money into and invest in.